From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Monday, November 13th. Here are the top market stories we are following for you at this hour. Countdown to CPI. Markets await tomorrow's inflation data as big banks diverge on their Fed outlooks. Morgan Stanley sees 300 basis points of cuts over the next 2 years. Goldman sees fewer and a later start. Countdown to shutdown. Government funding runs out Friday, and the House is racing to vote on a two-step continuing resolution to keep it going. But will Democrats get on board? And countdown to a debt crisis. Former New York Fed President Bill Dudley warns the U.S. fiscal position is on an unsustainable trajectory after Moody's lowered its U.S. outlook to negative on deficit concerns. From Washington, I'm Kaylee Lyons with Danny Berger in London. Alix Steele is off today, and Guy Johnson is on assignment. Welcome to Bloomberg Markets. Danny, I love to see a UVA takeover on Bloomberg television. And, of course, we love Virginia, but just across the river here where I am in D.C., there's a lot going on in terms of the political uncertainty and fiscal uncertainty as well. And it feels like markets have had to start to pay even more attention.
I was going to say it feels right to bring the Virginia crew together on a day where the fiscal concern and the political concern is front and center. But you're right. You mentioned what Bill Dudley said, that the unsustainable trajectory of a lack of political will, debt costs are soaring. But Kaylee, this is a market that has shrugged it off. It shrugged off the news from Moody's on Friday. And that brings us to our question of the day. Do you play political risk? As this is something that's underappreciated by the market, and it's time to jump in and price some turmoil. Joining us now is Bloomberg's Michael McKee and Liz McCormick. Liz, let me start with you. Are there any brave souls out there that are willing to play political risk right now?
Well, I'll say that some of the political risk is coming in not as a sexy way as we think for like some fancy trade, but that I think people not so jazzed about long-term rates is part of this. Some re-steepening of the yield curve has been filtering in this kind of, like you said, we've heard it for years, this unsustainable fiscal path, but it's starting to resonate, and the worry about Treasury issuance coming. You do see U.S. credit default swaps, that prices the default risk edging up a little bit, nowhere near where we saw in the debt ceiling episode. So I think, mostly it's just coming in, for some, people saying, I'm going to stay out of long end and, higher term premium and that kind of thing.
Well, Liz, that's what we essentially heard from Janet Yellen just a few weeks ago when she was speaking here at Bloomberg in Washington. When asked about what was happening in the bond market, she said she thought it was less about fiscal issues in the deficit, more about just the expectation of rates staying higher for longer. But, Mike, if we have Moody's, another credit rating agency, after two have already downgraded the U.S. from that top-notch rating, saying, hey, we're watching you and our outlook is negative, that can't be good, right?
Well, psychologically, maybe not good, and maybe it offends some people, but it isn't going to have a major impact in the markets, even if they would go ahead and downgrade the U.S. After we had the S&P downgrade in 2011, a lot of the bond contracts were rewritten, and the idea that everything had to be AAA was taken out. So if you drop to AA plus, you're not going to have a forced selling by money managers, which would have been the major problem. Obviously, it doesn't look good. It doesn't sound good. It may raise the cost of U.S. debt by a few basis points. But there's so much else going on out there right now, it's probably not going to be a big market effect. I'm not even sure a government shutdown would have a big market effect in the short term, because what gets shut down is so small compared to what it used to be. The expectation is that Congress is going to make a mess of this rather than they're going to fix it. So I'm fairly certain that stuff's priced into the markets for this right now.
Mike, you've literally just set fire to so much digital ink that has been spilled about the calamitous effect of a government shutdown. Okay, so if we don't care about that this week, tell me what matters more for this economy between the CPI data we're going to get, the different retail sales data, and the retailers coming out. If it's not D.C. we care about this week, what is it?
Well, it depends on which asset class you're talking about. I think the equity class would rely more on what the retailers outlook is, particularly for the holiday season and then going into 2024, because there's been a lot of questions about whether the consumer can maintain this. So what are the retailers seeing at this point? CPI depends on what happens. If it comes in as expected, not much market action. If it comes in lower than expected, then that's good news for the markets and the Fed. If it comes in higher, as one analyst put it this morning, then we've got chaos. So there'll be a lot of attention paid to that, but that would be the bond market that would be in chaos much more probably than the equity markets.
Well, Liz, when we think about the bond market and how it ultimately will react to CPI, whether it is cool or hot, if the reaction to CPI, if the CPI was actually lower than expected, and then it kind of locks in this market expectation that, OK, the Fed's done, nothing more to see here, and we see a loosening again in financial conditions, isn't the Fed likely to push back on that anyway? Isn't that kind of what we saw with Powell last week?
Yeah, I think, Kayleigh, that's been part of the problem that, if the Fed is, looking at long rates and tighter financial conditions off them, which they have said, at the Powell press conference, that kind of was the zeitgeist that we came out of it, then you're right. When stocks rally and bond yields fall, it's kind of working counter to them. So I think they're going to be, like you said, Powell kind of seemed to come back a little hawkish last week. I don't think they want the markets to run away. They like to be higher for longer, even if next year they have to ease, that they've talked about, just to kind of not get too restrictive, because if inflation keeps coming down, if they don't do anything, the policy rate will effectively get tighter. But I think they want full, workability to do whatever they want. So I don't think they want financial conditions easy. So it's a tightrope. They're trying to say we don't want to crush the economy. They seem to still be leaning in. They want that soft landing. But inflation is enemy number one still, and Powell has made that clear. So I think you're right. They're going to be on a tightrope to not let markets run away with themselves.
Well, it probably, Liz, doesn't help them much to have Morgan Stanley putting research out saying that they're going to cut in September. They're going to cut 300 basis points overall, a weaker economy, but no recession. I mean, 300 basis points worth of a cut in no recession. Surely this is not what the Fed wants markets to think.
Yeah, exactly. And the markets are pricing that. And I hate to say it, I'm no forecaster, but this is kind of like crystal ball time. And we know so many forecasters have been wrong. I'm not calling out Morgan Stanley or anyone particularly. But I mean, like Molly Smith had in her story today, Goldman Sachs is very different. They see much less cuts. And, there are many people who don't see that much, easing. They're kind of pushing back on the market, even pricing in about 100 basis points of cuts next year. So I don't know. I think the Fed takes these forecasts with a grain of salt. They know they themselves have been wrong. Inflation, of course, was not transitory. So I'm trying to take a beat and a breather from overreacting to these forecasts.
Yeah, transitory. We all know how that one worked out. I'm pretty sure that is still not a word that the Fed is going to be using for a very long time because everybody's scarred from it. Mike, when we consider, though, what the Fed is going to react to kind of bring this back to the fiscal questions, every time Chairman Powell pretty much is asked a fiscal question, he says, oh, that's not our realm. We deal with monetary policy. We're not going to weigh in on any kind of policy battle in Washington, D.C. But don't they have to care when what we're talking about is a massive deficit, trillions of dollars in debt, and much higher interest rates to be paying out, that the cost of this is going to go so much higher? These things are intertwined.
Well, they are to an extent, but the Fed can't do anything about the fiscal side, and they try to stay out of it because you never know what the proper course is going to be, and they feel it's better to have America's elected officials deciding it. Back in 2001, Fed Chairman Alan Greenspan said we should start selling off our treasuries because we've got too many, because at this point the U.S. is, we should buy them back rather, the U.S. is going to run surpluses forever, and we should cut taxes. And that didn't go over very well, and it didn't last very long. So they've learned something from that. At this point, the Fed wants to stay out of politics. And they also look at what you were just talking about, the year-end projections for what's going to happen, and they take it with, as Liz says, a grain of salt or maybe a boulder of salt, because nobody really knows. And I think that's the problem here, is that the markets are looking for some sort of anchor, something that will tell them what the Fed is going to do, and there really isn't anything out there at this point. There isn't a clear consensus on where the economy goes or where the markets go, where the Fed goes, where interest rates goes, and so that's very hard. And so you get kind of volatility, and you get people looking for various kinds of forecasts that maybe they can glom onto, just not there. And we're going to go through this for a while.
Yeah, maybe the only thing that's clear is that nothing is really clear at all. Bloomberg's Michael McKee and Liz McCormick, thank you both so much for joining us. Now, coming up, we're going to get more insight into our question of the day. Do you play political risk? We'll ask Catherine Rooney-Vera, Chief Market Strategist at StoneX Financial. This is Bloomberg.
We're really on an unsustainable path.
Fiscal policy is an issue.
Fiscal policy, obviously, it's a concern.
Just awful fiscal dynamics that aren't going away.
As a signal of how dysfunctional the U.S. policymaking is.
Just moving from one congressional crisis and government shutdown threat to the next.
We're going to see probably another alleged crisis on November 17th.
Risk of government shutdown.
Looming government shutdown.
It's really the length of any potential government shutdown is the issue.
If it's more than a few days, you have some impact that can be felt from an economic standpoint.
I do worry about the credit agencies.
There's Moody's rating.
There's a risk of, economic slowdown and potential recession. This could add to that.
We don't know what's going to happen.
Kind of an open question of how this all resolves. Those were Bloomberg TV guests earlier weighing in on some of the risks markets are facing, a lot of them fiscal. That brings us to our question of the day. Do you play political risk? Here now is Catherine Rooney-Vera. She's Chief Market Strategist at StoneX Financial. And Catherine, obviously there's a number of political risks. We could talk about the threat of a government shutdown, just the fiscal trajectory of the United States, conflicts in the Middle East and Ukraine. My question to you, though, is does any of it really matter?
It's hard to play political risk, and I wouldn't advise attempting to. But what I am concerned about on a structural basis is, of course, what your clips mentioned before, which is fiscal responsibility. And the fact is that the U.S. Economy is not growing at a rate commensurate with a $1 trillion fiscal deficit. Add to that the $2 trillion QT that the Fed is currently engaged in, increasing borrowing needs for an economy that's growing minimally, and I think next year has a very elevated risk of recession, which only aggravates those needs. When you look at interest costs as a percentage of GDP, Kaylee, it's pretty concerning when you look at that trend. Over the past about 1 year, you've seen interest costs as a percentage of GDP go from 2.4 to 3.6%. That's very significant, especially, and this is probably what concerns me the most, with the Fed not being, that price-insensitive buyer. You have a lot of price-sensitive buyers that are caring about where treasuries are trading.
Yes, and it's this question of what happens with the Fed still doing QT, what happens with the BOJ maybe tweaking policy, who's left to buy bonds. So, Catherine, is that how this manifests itself, just in continued pressure, continued higher yields, especially on the long end of the curve?
It's a structural issue, but for the time being, and I think Mike McKee alluded to this, it's not something that I think is going to be a debt crisis immediately, because the fact still remains there is no market as deep and as liquid as the U.S. Treasury market for those countries with those enormous current account surpluses, China, Russia, Saudi Arabia, in which to invest. So China is trying to diversify into gold. But the fact is that probably over the course of the next couple of years, the U.S. is going to remain the main player, especially when the U.S. dollar remains the sovereign reserve currency of the world. So in the meantime, if political risk, such as government shutdown, actually causes yields to go higher, equities to go lower, then we could talk about playing political risk. But I think we've all learned this lesson before. We've seen this story play out multiple times, several times a year in some cases, that government shutdown is something very temporary in its market impact.
Yeah, well, markets, at least for the time being, seem much more concerned with the monetary policy path than the fiscal one, because that's the more immediate threat or concern, if you will, that we're dealing with. And on the monetary policy path, there's a lot of conflicting research out there that Danny and I have been discussing. You have Morgan Stanley calling for 300 basis points of cuts from the Federal Reserve between now and the end of 2025. Goldman sees 175 between now and the end of 2025. Then you have UBS out saying 275 basis points of cuts by the end of next year, by the end of 2024. Catherine, which side of those three do you think is perhaps most accurate?
Soft landing is inconsistent with multiple hundreds of basis points in cuts next year. I don't think those two can mutually survive. So when we're talking about 200 and 300 basis points within a soft landing or a no landing, makes no sense to me whatsoever, unless we're talking about nominal rates remaining so high, immaculate disinflation continuing its miraculous move lower. I'm just not a believer in that. So I think that something has to break for the Fed to cut in such an enormous way. I think something will break, and that's what's required to get inflation, if the Fed has a strict interpretation of its dual mandate, to that 2% target. So yes, I do think there's a good chance that the Fed cuts rates next year, but it's not going to be pretty. So, we get this idea that equity markets are going to rise because bond yields move lower. Well, not necessarily the case, Kaylee. When bonds are moving lower because the economy is moving into contraction, valuations are currently not strong enough, not healthy enough to withstand a drop in earnings expectations going into next year, which I think is going to be the case. I think companies are going to have a tough time maintaining margin expansion in an environment of still high labor costs, still high energy costs, and still high interest rate costs. Real rates are very high. So I think we're probably more likely than not going to get employment shedding next year. And that's going to take a downward impact, or have a downward impact on consumption.
Right, but in the meantime, equities seem to not care. Sure, they're a little bit weaker today, but as this bond market's been whipsawed around, as the front end of the curve goes above 507%, equities have been higher for 9 out of the past 10 sessions. What is it going to take to actually care, to click in this idea that if we're pricing in rate cuts, it's bad for the equity market?
Right. I think we're going to have to actually see a recession, Danny, because when you look at things, consumer confidence is still remarkably robust. Retail sales is pretty resilient. So until we see a rollover in confidence, which is a leading indicator for consumption, think about it. Consumer discretionary, you're not going to change your habits of consumption if you still have a job, or if you're getting wage increases. Even if they're not equivalent or higher than inflation, you're still going to maintain your habits of consumption. What fundamentally could change that, I think, is threats to your job security. So until we see some rollover more meaningful than what we've seen in the labor market, that's when I think that the market is going to realize that equities are going to have a tough time sustaining themselves in a stagflationary or recessionary environment next year. That's why I prefer fixed income over equities going into next year. And the fact is, equity risk premium in the US, in Europe, maybe only in Japan, but US and Europe just looks honestly atrocious. So I don't see why you would want to take risk at current levels, adding to positions that have done so well year to date, particularly the ones that historically underperform in recessionary or stagflationary environments. And that's tech, that's discretionary, that's communication services.
Well, to your point about you preferring fixed income to equities going into next year, how much risk, though, do you see in that call to be longer in duration in the bond market, considering we have seen such volatility in the bond market that it seems like it's just very unclear what direction things are going to go when we're moving this number of basis points with this degree of frequency pretty much every week?
Right. That's a good point. I think you still want to stay in short duration paper. It's still yielding very juicy levels, equal to, or in some cases better than the earnings yield on the S&P 500. But certainly, I think in this fourth quarter, especially as we go into recession or look like we're going to, it's going to be time to find some duration in those higher quality investment grade names. I'm not talking about high yield. In fact, I would be recommending buying CDS on high yield. We haven't seen the credit cycle fully develop yet. I don't think that this is a whole new reality. What we've experienced, Kylie, from my perspective, is an aberration. It's not an entirely new economic scenario. So I think that recession and the credit cycle has been postponed. It's not been altogether avoided.
Yeah, you and UBS saying we don't see why things would be different this time. Catherine, I'm afraid that's all we have time for. Thanks so much for joining us. Catherine Rooney-Vera, Chief Market Strategist at StoneX Financial. Now, still ahead, Apple plans an ambitious iOS update as it looks to compete in the AI market. We're going to have the details in the startup next for you. This is Bloomberg.
It's 20 past 7 on the West Coast, so let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Caroline Hyde. And Caroline, I look at a day when broadly stocks are down, and yet the one that is leading the charge for the S&P 500 biggest points contributor is NVIDIA, again, proving to be a powerhouse. There is some news, though, related to that name, though, in terms of the processors it's using for AI. Walk us through it.
Yeah, H200 is its name because everyone's already been out there sort of trying to stand out with the fact that they've been able to stockpile the H100, of course, this AI processor that NVIDIA has become the darling for more than anyone else. Just think we had Kai-Fu Lee on Bloomberg TV last week saying he'd done exactly that ahead of course, restrictions between China and the US. Now, this time, they're updating those AI processors to make the access to memory even greater. Basically, you're going to be able to deal with far larger models, far more data, ultimately, to be able to train the AI systems, the models that much faster. You basically bombard software with data at a quicker speed. And why is NVIDIA doing it? Because, yes, they're already the darling, they're the standout, but you are getting some more competition. AMD, for example, has a rival chip coming onto the market. So too does Intel. So they're just trying to stay that step ahead and ensure that some of the cloud companies, already Amazon and Google Cloud, for example, saying that they're going to be lining up to use this chip come the second half or indeed the second quarter of 2024.
Well, speaking of trying to stay up with AI, Caroline, I mean, I'm still over here hanging out with my iPhone 12, so I'm definitely behind times. But Apple is trying to put in some. It's a very normal sized phone, let me tell you. Nothing to be ashamed of. I'm saving the planet by not getting a new phone so soon. But Caroline, tell me about this update that Apple has been working on, a new iOS trying to conquer AI.
18 versus 12, but I'm loving that you're doing your thing for the planet. But ultimately, this is about a new level of software that actually for the first time in a long time, actually, we've seen an out-and-out pause. Now, this is all about trying to understand and get to grips with some of, well, the issues, some of the already bugs that they've got in the system, the operating system, that's going to make things building on top of a software that much harder. Now, when they bring out a new software, iOS 18 is going to be all the more important next year for Apple. Why? Because we're not going to have that many changes to the actual phone, the hardware at the moment, but it is all going to be about what the software is going to be like. Ultimately, they're going to have to play catch-up with the OpenAIs, the Googles, and their Bards to ensure that they can offer generative AI usability on an iPhone. But to do that, you've got to have some really powerful software. That's why we actually saw, for the first time in many, the fact that they're deciding to just put pause for a week so they can get to grips with the glitches, with the bugs, to ensure that iOS 18 works phenomenally well when they do indeed unveil it come June. So it's interesting that Apple itself having to just take some time out, clear out some of the bugs and ensure that ultimately the product that they're able to unveil is really quite phenomenal. And indeed, many are waiting with bated breath as to what Apple really does do when it comes to generative AI. We know they're investing a lot, but it's all been kept quite quiet.
Danny, is new software going to be enough to upgrade your iPhone 12?
I don't know. Maybe if it has AI on it, if it can do some chores for me. I don't know, guys. I'm so behind. I need to think about this. Maybe I will. Caroline, thank you very much. Bloomberg's Caroline Hyde helping me shop around for my next phone. Bloomberg Tech, of course, comes up in around 90 minutes time.
We are an hour into the U.S. trading session, not starting off the week on a very positive note when it comes to U.S. equities. Bloomberg's Abigail Doolittle is tracking the moves. Abigail?
Well, Kelly, that is indeed the case. We have the S&P 500, the NASDAQ 100, and the Russell 2000 all lower. A relatively modest loss for the S&P 500 after 2 weeks of big gains, down about 0.3%. You can see the NASDAQ 100, mega cap tech down more. We'll be taking a look at that in a moment, down about 0.5%. And then Russell 2000, last week, the worst week since September, at one point almost the worst week since March, still down about 0.7%. So banks continue to weigh. But the big pressure on equities more broadly, risk assets, of course, has to do with yields rising. Although we are, as you can see, off of the highs. The 5-year yield had been up 3 to 4 basis points earlier, now up about 1 basis point. This, of course, after last week's hotter than expected inflation look forward on the part of consumers ahead of CPI tomorrow, retail sales on Wednesday, and then PPI later this week. Lots of inflation data and clues on what might be ahead for the Fed. So investors a little bit on edge. Now, with yields rising, that of course pressures mega cap tech, or it has tended to pressure mega cap tech more. NVIDIA not really doing the same as the rest of tech stocks, up about 1%. But you can see Apple, Microsoft, and Advanced Micro all down quite a bit ahead, especially ahead of CPI tomorrow for the month of October. As for small cap, let's take a look at an interesting chart, because in the past, a lot of times ahead of major sell-offs, the kind that take months and months to move toward, we have had small cap lead. It's growthier, domestic base, the valuation's higher. You can see that we're now down 2 weeks in a row, Russell 2000 relative to the S&P 500. But the greatest underperformance last week, Danny, more than 4%, going all the way back to 2021. It's something to keep an eye on, again, just because when the small cap sector tends to sell off, the Russell 2000 right now down about 3% on the year relative to the S&P 500 being up, I believe, about 10% or so. Just something to keep in mind in terms of that some investors out there are not completely on board with the stock story.
Okay, Abigail, thank you very much. Abigail Doolittle. Stocks might be down this morning, but oil is heading higher, nearly 1%. But the head-scratching thing is that since the terrorist attack on Israel, since October 7th, we're actually down nearly 10% on NYMEX crude. So what do you do with that? Do you still play the political risk in this market? Let's get to our guest. Joining us now is Rebecca Babin, CIBC Private Wealth Group Senior Energy Trader. Rebecca, what do you make of that, of the premium, the war premium that's been priced out of this oil market? Should some of it be priced back in? Do you play the geopolitical risk?
That's a good question. And my honest answer is I don't think you do play the geopolitical risk in crude. And there's a couple reasons for that. First, I think it's become pretty clear that crude oil supply, even in the event of an escalation, isn't going to be immediately impacted. And there's two reasons for this. First, neither side benefits from that, right? The Israel-U.S. side clearly doesn't want rising oil prices heading into the election. But if you look at Iran, if they were actually to be pulled into this conflict in a more extreme way, if crude supplies are disrupted, they've benefited from increased exports this year to the tune of 400,000 to 500,000 barrels over what was expected. Let's say something extreme happens and they are threatened. Would they want to close the Strait of Hormuz and impact their one and only customer, China, in a negative way? I don't think so. So I don't think the incentive is there for crude supplies to be disruptive, as tragic as this conflict has become. I actually think crude supply will remain kind of off target. So I don't think you chase those rallies that come from geopolitical risk in crude. In fact, I think what we've seen is people are using those rallies to either establish short positions because they're concerned about demand or take profits in those events. So I don't think that's what you play. What I do think is interesting on the supply side, though, is we did see the U.S. issue notices to 30 shipping companies today for violations of sanctions in Russia, for violating the sanctions on the price cap. That's something I think you watch, because if we actually enforce those sanctions, which is a form of geopolitical risk, we could see real supply impacted. And I think that's why we're actually up today, the percent that you're seeing.
Well, to that point on supply, Rebecca, even in the absence of some major geopolitical disruption, if that doesn't happen, doesn't that just continue to give leeway to OPEC Plus to continue keeping supply constrained? I just wonder if ultimately it still has the same effect because they're still going to want to keep prices elevated.
OPEC is certainly going to want to keep prices elevated. I think they really care about that 80 level in Brent, and they need it actually closer to 90, at least in Saudi Arabia's case, to kind of balance budgets. So I do think as we head into this November 26th meeting, which is critical for the 2024 setup in crude, I think the market is now starting to lean that they roll over their voluntary cuts, Saudi Arabia's voluntary 1 million barrel a day cuts, through January, at least in 2024. That has not been consensus. This is a shift we've seen over the past month as prices, as you noted, have fallen about 10%. So they need to continue to keep those cuts going, to keep the market in balance, to hold these critical levels of support. And I think they will continue to do so. But Also think the uncertainty around that is part of the reason why we've seen this frictionless sell-off that we've had, this 10% move. Demand has not cratered, but uncertainty about how they are going to conduct their supply mechanisms in 2024 is really keeping people on the sidelines. I don't want to engage with this market unless I'm confident OPEC is going to be there.
Right, and I mean, Abdulaziz bin Salman has been talking about these moves as being a ploy by speculators. We also had the latest OPEC report saying that it's overblown negative sentiment that's dominating the global argument. It does sound like you would agree with that, and you even write perception has become reality for crude oil. So what is the reality for crude right now that this market is overlooking?
That's a great question. So the reality for crude is that we're looking at a year that has had over 2 million barrels a day of demand growth, which has outpaced expectations, but has also had supply growth that has outpaced expectations. So the draws haven't been quite as huge as the market was expecting, and a disappointed market is not one that rallies. Even if demand isn't falling off a cliff, the fact that supply has filled it in has taken the momentum away from crude, right? So it's been very hard to rally. I do think we have CTAs, which have been shorting into any geopolitical rallies, and we don't have a lot of conviction from the macro community about what happens to step in and buy the dip. So I do think the sell-off is overblown. I think it's more of a paper sell-off than a fundamental sell-off. So I do agree with that statement. I think what we need to see, though, is continued inventory draws in 2024. And we had a nice set of draws in the summer. Things got more balanced. We've had some builds, and you're going to need to see, if you want this market to be strong, stable, and rally, the draws need to continue to come. And I just don't think you see buyers unless you have that. I think if OPEC stands pat and rolls their cuts into 2024, you will see the draws. Market will continue to be strong. But if you don't, the market is going to continue to question everything. And that idea that perception becomes reality, as soon as everyone starts talking about demand being weak and the fears, you just see this huge unwind of crude longs. And there's just not enough conviction on there to buy the dip.
Well, and Rebecca, there's the question of where that demand is or is not coming from. You already mentioned China in the context of it being the primary buyer at this point of Iranian crude, but especially considering we have Xi Jinping coming here to the U.S. this week to meet with President Biden, and he's doing so against a backdrop of a Chinese economy that, frankly, is looking quite fragile. There's a lot of areas of difficulty within China. How crucial is it in particular to the trajectory of the oil market?
So it's crucial. So if we look at next year, we're looking at consensus of looking for 1 million barrels of demand growth in 2024. Again, we had over 2 million barrels so far in 2023. So no one's expecting another year like this year. But of the million that we're supposed to see next year of demand growth, 500,000 of that is expected to come from China. So that is a pretty massive indicator for crude, and people follow that closely. So yes, that is going to continue to be critical. What we saw this year, which is interesting, is we've seen fuel consumption and gasoline demand diverge from those headline macroeconomic numbers. The headline numbers have been getting weaker. Gasoline demand and fuel consumption has maintained its robust trajectory. Now, the question is, does that continue in 2024, or does it kind of revert back to mirroring the macro headline numbers? I think it probably does come back to those macro numbers in 2024 because we had this reopening trade, and that's what you need to watch. My sense is, though, consensus is pretty moderate on what we get from China, and we do get more stimulus. I think they will deliver. And we will see that demand growth met, but they are the key for this year and next year.
All right, Rebecca Babin, we have to leave it there, but thank you so much, as always, for joining us. She, of course, coming from CIBC Private Wealth Group. Meantime, one of the world's biggest aerospace trade fairs is underway, and that's where Guy Johnson is. It's why Danny and I are here today, and not Alix and Guy. He is at the Dubai Air Show, and he spoke to Ted Colbert, CEO of Boeing's defense, space, and security sector. They spoke about the industry's capacity, particularly with ongoing wars.
We are all working together to make sure that if we have to do more, we can do more. I think that is the game plan right now. I think we've learned a lot over the last year or so, and that will inform our way forward. It'll inform how we capacitize. It'll inform how we think about, frankly, modernizing what we have today. One of the reasons why it's important to be here is because this region, to me, is all about making sure that modernization and readiness are exactly where they need to be. If I think about anything beyond the two wars we have today, it's about modernizing platforms like the Apache, modernizing the Chinook, making sure you'll see later on today, hopefully, the F-15 QA will fly. That is an example of what we all need to be working together to do to be ready for anything that happens in the future. And that plane shares a bunch of likeness with the Saudi F-15 and the United States F-15EX. So readiness and modernization will be the keys to supporting anything that goes forward.
That was Ted Gobert, CEO of Boeing's Defense, Space and Security sector, speaking with Bloomberg's Guy Johnson from the Dubai Air Show. And in the next hour, we'll have Guy's interview with the Emirates President, Tim Clark. So make sure to stay tuned for that. Coming up first, though, President Biden preparing to meet China's Xi Jinping at OPEC in San Francisco this week. We'll have a preview of what's on the agenda coming up next. This is Bloomberg. This is Bloomberg Markets. You're looking live at the Principal Room. Coming up, San Francisco Mayor London Breed joins Bloomberg TV at noon New York time. This is Bloomberg. President Joe Biden and Chinese President Xi Jinping are expected to meet on Wednesday on the sidelines of the APEC summit in San Francisco. The gathering will be the first face-to-face conversation in a year between the leaders of the world's two largest economies. Bloomberg's Enda Curran is joining me now here in Washington with the details. So, Enda, obviously this is a pretty high-stakes meeting. What primarily is on the agenda? Are we going to have any tangible outcomes achieved?
Well, I think number one is a stabilization of relations between both. There will be specifics. They're going to talk about military communications. They will talk about trade and investment. There will be talk around fentanyl, for example. There's lots of issues where the two leaders will discuss where they can and cannot cooperate. Some news reports out there saying there could be some agreement on AI in the use of military weapons, for example. But ultimately, whatever tangibles come out of it will be fairly small beer to the fact that they're sitting down at all in the first place. That's what a lot of people are saying. It looked unlikely even as recently as a few months ago with the debacle that we had post-balloon and everything else. So it's about stabilising relations, I think, more than any major breakthroughs.
And great to speak with you. I was talking with Bobby Ghosh of Bloomberg Opinion earlier in the day, who was saying that China has a weak hand coming into this, given where they are in the economy. She, of course, is meeting with business leaders and others, not just Biden. What is a good outcome for China as it specifically relates to getting the economic support that they need?
Well, there's no doubt that China's economy obviously is in something of a funk at the moment relative to where it has been. But more importantly, sentiment and the optics towards doing investment in China is certainly in a bad space. And I think that opportunity where President Xi is going to have a large-scale dinner with business executives, that will be an opportunity, Danny, for China to say, look, we're here, we are open for business. Despite everything that you read and hear, we're still willing to accept your investment. So if he comes away by at least calming corporate fears, that would probably be taken as something of a win for the Chinese side. But remember, China, even though it's economically weak at the moment, does bring some weight to the table, and that is they are now, of course, in an alliance with Russia, and they have more weight in the Middle East than they've had in the past as well. So there are certainly some geopolitical aspects that China can bring to the table that it once wouldn't have been able to bring to the table.
Well, and on the subject of geopolitics, and obviously the conflicts in Ukraine and in Israel and the funding the U.S. is providing to allies in both of those cases is very much in question here in Washington, especially after over the weekend, Speaker Johnson outlined his continuing resolution plan, 2 steps, but no funding for such things is included. Has the risk of a shutdown at the end of this week gone up or down now that we have that CR outlined?
Well, maybe modestly down, you're right, but it seems that the new Speaker of the House is saying, look, he's going to try and avoid a shutdown. He wants to bring down spending overall, but he wants to do this in a piecemeal version. It's not going to be all solved this week. They're going to work this out as they go along. Now, whether or not he can bring enough lawmakers along with him and agree on that, some Conservatives in the Hill apparently disagreeing with that approach. Yeah. But the point is, he seems to be trying to avert a shutdown, but he's also saying there are going to be spending cuts. And to your point then, that brings up the topic of how much more support will be ongoing for Ukraine and other military conflicts around the world. I think it's an open question.
Enda, thank you very much for joining us. That is Bloomberg's Enda Curran, the latest from D.C. on the shutdown. Now, coming up, we're going to get the view on the potential government shutdown, but what it means for Wall Street and what it means for the big banks. We'll talk about it in today's Wall Street Beat on Bloomberg.
It's time now for Wall Street Beat, where we look at what is buzzing on Wall Street and the world of banking and finance. And today, we're looking at Moody's decision last Friday to cut its outlook on the U.S.'s sovereign credit rating to negative from stable. This all comes down to the fiscal trajectory here in the U.S. Joining us now is Bloomberg's Sonali Basak. So, Sonali, we haven't seen really much market reaction to what Moody's published on Friday after markets closed. But does this have an implication for big banks in particular, if not necessarily immediately for financial markets?
Listen, this has definitely been a very slow-moving train wreck, hasn't it, Kaylee? And if you think about it, another downgrade, what would it mean? Of course, they moved the outlook to stable, but another downgrade would be coming on top of other rating agencies that have made similar moves. And it's underpinned by a risk here of just the larger U.S. fiscal situation, which you guys have been talking about. So what does it mean for banks and asset managers? First of all, the initial reaction on Friday was movement in the futures market. A lot of asset managers really buy or short treasuries through the futures market because of the margin required. And remember, the volatility of the asset class would mean that there is more margin required to be posted for the futures contracts in particular. And then in the context of the basis trade, where you have a lot of asset managers who are buying the spot and shorting the futures and looking to really profit off the difference as they converge and lever that trade up yet again with more treasuries and leverage from repo markets, all of this could just make that process more expensive and create risks of whipsawing what is currently a massive trade and being used by levered funds like hedge funds to be buying treasuries up front. So when you're seeing these supply issues hitting the market, when you're watching new treasury issuance, problems like this exacerbate problems like that. And you're seeing the cyclical issue come to the surface at a time when you have many traders really worried that next year would get worse, not just because of these downgrades, but because of these exacerbated fiscal situation you're seeing for the United States, as well as this other big idea here that bank balance sheets are shrinking and facing more regulation.
I mean, what you're talking about, Sonali, it's specifically hitting the U.S. Treasury market. When you look at the reaction of other asset classes, I mean, equities apparently didn't get the memo that something could be up. So what are the wider ripple effects that could come as a result of this?
Now, you have to think about it. There's two things here. We're talking about margin being required to be held against the Treasury trades in particular. The idea that not only is it going to get expensive because of future regulation potentially coming down the pipe, but also this idea that if you're in a country and you're an issuer in a country, you cannot be rated more highly than the country itself. The one worry that there is underpinning the markets here, besides the Treasury market, is to what degree this will start to impact other borrowers, from investment grade to even riskier borrowers, at a time, Danny, where we're seeing more fallen angels. We're seeing more companies fall into junk territory and more companies also facing bankruptcy at the dire end of the spectrum. And so we've seen a wave of issuance kind of front run a lot of economic data into the last couple of weeks. But when you see problems like this compounding, you have to wonder if it will really stop the party on Wall Street and make issuance much more difficult at a time where refinancing is already coming at much, much higher rates.
Yeah, it's really interesting to think about from where I sit here in Washington, Sonali, as if we avert a government shutdown, but it doesn't come with steep spending cuts. If that actually ends up being the worst case scenario for Wall Street, then potentially a shutdown in which conservatives are able to extract some deep spending cuts in order to bring it down. So it kind of is a question of like, what outcome does the market really want here?
Totally. And, you know, tomorrow, for example, we're going to spend about an hour with Ken Griffin, founder of Citadel. And they're one of the big levered funds that I've been talking about that has been engaging in the basis trade. One thing I'm going to ask him about is how much more capacity can they really take on in treasury markets, particularly with this dynamic. We've seen massive fund managers to the likes of Stan Druckenmiller really come down on even the Treasury Department for not managing the rising financing costs better. Is there something to be learned from this experience that should create a difference in how we finance the United States moving forward?
Shonali, thank you very much. That is Bloomberg's Shonali Bassick. And of course, as she mentioned, she's going to be sitting down with Citadel CEO Ken Griffin, who has been saying it's the banks that regulators should look at around the basis trade, not the hedge funds. That will be on Bloomberg TV and radio at 1 p.m. in New York, 6 p.m. in London. All right, as we get closer to the European close, we're a little over a half an hour away. Let's get your check on markets. Sterling is higher this morning. Now, we're going to talk a lot about this in the next hour. There's a lot going on here. We're higher by about 0.25%. Yes, there's CPI in the U.S. tomorrow, but the big data point domestically here in the U.K. is going to be CPI the following day, on Wednesday. At the moment, we're treading higher. Political chaos, shall we say. Political reshuffling maybe is a better word, not quite chaos, also happening here in the UK, affecting things. European stocks moving higher, up 0.6%. Novo Nordisk really adding to that. Latest study showing that their Wegovy drug, the weight loss one, helping to cut heart disease. Finally, 10-year yields in Germany really just tracking treasuries up a basis point, but Morgan Stanley says 10-year bonds should be at 1.8%. Okay, coming up on the European close, we're going to be speaking with Claudia Panseri, UBS Global Wealth Management Chief Investment Officer of France. She's our guest on Bloomberg.